YouTube. What happens after the Chipotle stock split? So thank you guys for tuning into the Life Changing Finances YouTube channel. Make sure you guys like, share, and subscribe. So a few days ago, we put up a video titled Chipotle 50 for 1 stock split. And this is going to be a follow-up to that video. So a lot of people are not familiar with what happens during stock splits and what they are. So we're going to tailor this one specific to Chipotle. Okay. Now, a stock split lowers its stock price but doesn't weaken its value to current shareholders. So that's something that you need to know. You don't need to be surprised or confused about that. Now, it increases the number of shares and might entice would be buyers to make a purchase. Okay, so we'll talk about that in just 1 second. The total value of the stock shares remains unchanged because you still own the same value of shares, even if the number of shares increases. Okay, now let's go ahead and dive a little bit deeper. So, in a stock split, a company divides its existing stock into multiple shares to boost liquidity, right? So, the whole objective to this is to bring more money into the company. That's what the entire objective really is about. To getting, like we said, it's supposed to entice more buyers to come into the space. Now, the one thing that is major, and we'll scroll back up in just a second, I want you guys to look at. So if you look here, these are the basic stock splits. You got 2 for 1s, you got 3 for 1s, and then you got 3 for 2 and 1 for 10. But a 1 for 50 is not necessarily something you normally see. So Chipotle is really trying to entice more shareholders to come into the company, right? So that's a big statement. That screams that they're doing what it takes to really expand the company, bring more investors into the space. You know, using that capital to expand even more, to bring up more restaurants and maybe decide to do something even more with certain projects, right? So this is something that's making me really bullish on this stock. So again, as we stated in a previous video, we know right now that Chipotle is about $2,900 per share. But again, you can't let this derail you from investing. So a lot of these platforms, you can buy fractional shares. If you got $5, you can buy Chipotle. If you've got a Robinhood account and you got $1, you can buy a piece of Chipotle. So no matter what you have, 10, 20, $30, you can put it into Chipotle. Now, I'm not giving financial advice and I'm not telling you to buy it right now. That's not what I'm saying. But you guys get my drift. Okay. Now, companies may also do stock splits to make share prices more attractive. So we kind of spoke about that before. So uh, and we did the math in the initial video. We, I think, said that at its current price, it would bring it one share to like $58 or something like that. So, to the human brain, what looks better, $58 or $2,900? I think you guys know the answer to that. Okay. Now, for shareholders, the total dollar value of their investment remains the same because the split doesn't add real value. Okay. So that means if you have $1,000 worth of Chipotle, after the stock split, you're still going to have $1,000 worth of Chipotle. All right. So it's not going to change the amount you have invested. It's just a tactic to bring in more investors. Now, the most common splits are 2 for 1 and 3 for 1, which we already looked at. A stockholder gets 2 or 3 shares, respectively, for every share held. But in this case, you're going to get 49 shares on top of the one that you own. Okay, so that's really good to know. Now, the last thing before we go is a company divides the number of shares that stockholders own in a reverse split, raising the market price accordingly. Okay, so that's something a little bit different. If we have anything with a company that says they're going to be doing or announce that they're going to be doing a reverse split, then we'll come back and revisit this. But I just wanted to do a follow up video on that initial Chipotle video. I wanted to explain to you what would happen. Now, I'll be honest and I'll tell you guys this. I've seen stock splits where they bring in a lot of capital, right? So if a company has let's say a $10 billion market cap. I've seen them go from $10 billion to 13 or $14 billion in one day. But um, when you're looking into this, you have to think long term. So what could possibly happen initially is, let's say a week before the stock split, you'll see the price start to go up, right? And then after the stock split, it goes up, and then maybe a couple days later, it'll dump off. So if that were to happen, do not be discouraged. That's normal. That's called a pump and dump. So usually when there's a lot of momentum and a lot of news and media is really backing what's happening with the company, you'll see that initial rise off, and then it'll dump off, and then you'll see it kind of consolidate before it starts to take back off. So keep that in mind. And if that happens, don't be discouraged. All right. So I wanted to get that last point in there. So thank you guys for tuning in. Like, share, and subscribe, and we're out. Peace.